the macro view, which I don't agree with, is that the Fed has everything under control and that we will taper and ultimately go back to pre-2008 Fed-sized balance sheet, and everything will just be fine and dandy, and it's just a view that I don't share at all. But that view seems to be the predominant view, and I think every time they talk about tapering, gold goes down a little bit more. I was amazed how last week there was some bad economic data, but the one thing that the bears on gold seized on was there was a slight improvement in the ISM, the Institute for, I guess, the ISM index, which was an indication of manufacturing. And yet nobody worried about the fact that retail sales on Black Friday were very disappointing. So you have this very selective use of information by the bears on gold, which is all in support of this idea that the economy continues to be on the mend, and therefore these radical monetary policies are temporary. And my view would be that the radical monetary policies that we have today are not going to go away, and they're probably going to get even more radical. I've been bullish on gold for the last couple of years, and I've been just flat out wrong about that. And I think what I failed to take into account, and I'm just beginning to sort of get my arms around, is this deleveraging in the paper gold trade. How long is that going to continue? I don't know the answer to it. You would think that the gold that is still in investment hands today is extremely well held by people who have heard all these negative macro and false, in my opinion, macro arguments against holding gold. So I would think that we're coming near the end of that. And I would say within the next year, I think we will see a turn in the gold price. And, longer term, I'm extremely bullish. I think gold will trade at higher prices than we had in 2011. I think we'll see gold trading north of 2,000 by a handsome margin. They're so different. I mean, owning physical gold, you almost shouldn't, and you don't need to take a directional view. You only need to know that it is an alternative asset, tangible, that has monetary characteristics, that is not captured, if it's held in the right way, within the framework of securities and banking regulation. That's all you need to know. You don't have to believe that it's going to do anything in terms of dollar value or sterling value of what I just said. Mining stocks are completely different. They are basically an attempt by the proprietors, the owners, the shareholders to create value through the business of mining gold. And it obviously helps or hurts if the mining price is going up or down. It's almost the only thing you need to know. But the fact of the matter is you need to know a lot more than that. But in the right phase for a move in gold, and if you're seeking excess return, own the mining stocks, because they're going to give you much more than the gold price. I'm not sure it's an opportunity, but I think it has to be understood that that's what's going on. And if you understand it, and maybe even better than I do, it might give you some sense of what would, when the paper market would change and start driving the gold price higher. What we don't really know is how much these various instruments of intermediation, the gold GLD, for example, the buildup in open interest on COMEX, how much all of that was responsible for the rise in the gold price from 2000 through 2011. So I'm not sure that I'd put it in terms of being an opportunity, but I think in terms of trying to understand what's going on, it's pretty important. And of course that can turn around. So the paper market, which has been harmful to gold for the last 2 years, could become a positive again, because it frankly creates access to gold ownership in a very diluted form, but it creates additional capacity for gold. I did a study of the market cap of the COMEX open interest, and you compare that to, for example, copper, oil, some of the grains. It's one of the very biggest. So it's important in the sense that if capital wants to flow into gold, to buy physical metal is a real pain, as we all know. I mean, that's why we started Tocqueville Bullion Reserve, to create an institutional grade product so that wealthy families who wanted to own physical gold could choose between, say, GLD, where they track gold, or Tocqueville Bullion Reserve, where they actually own physical gold. But what all of these things do in one way or another is add to the capacity to absorb capital flows in or out for large pools of money. And so that's why it's a very important thing to understand. It's a terrific way for to meet a lot of people in a short space of time, and you know, there's a lot of cross fertilization in terms of meeting different investors for someone like me, or different providers of services like some of the consulting companies. So it's a great, to me, melting pot. It's a very different format than the Denver Gold Group, where you really just get companies and some of these other comparable things. So I think it's got a unique place.